Applied Materials' 124% surge risk compels business leaders to strengthen their AI strategy and build lasting value. You need to look closely at Applied Materials' massive 124% year-to-date surge because it exposes the exact risks that could break your current AI strategy. If you are blindly riding the market enthusiasm without building lasting value, your entire AI bet might be on the verge of collapsing. On July 10, 2026, Applied Materials closed at a striking $602.50, bringing its year-to-date share price increase to that jaw-dropping 124%. This massive surge shows you exactly how artificial intelligence capital expenditure is shifting semiconductor equipment valuations while handing you massive execution risk. The financial markets are heavily rewarding companies in the AI infrastructure supply chain right now, but you cannot let valuation expansion blind you to real operational and geopolitical dangers. L-Impact Solutions explicitly warns you that executive teams should focus less on temporary market enthusiasm and far more on high-quality capital allocation. You must build customer diversification and technology resilience right now instead of just assuming today's explosive growth trajectory will stay unchanged forever. If you look at the broader industry, you will see we have entered one of the strongest investment cycles in decades, driven by massive hyperscale cloud providers. You should note that sovereign AI initiatives and enterprise digital transformations are accelerating chip demand to unprecedented levels. Industry forecasts now estimate that global semiconductor revenue is rapidly approaching $800 billion over the next several years. You should prepare for wafer fabrication equipment spending to remain above $120 billion annually, opening massive windows for deposition and etching technologies. If your business focuses on inspection or advanced packaging technologies, you are sitting on a goldmine of sustained infrastructure opportunities. You need to realize that AI servers typically require significantly more advanced semiconductor manufacturing processes than traditional computing systems. This processing intensity directly drives up the demand for complex manufacturing equipment across multiple crucial fabrication stages. Investor optimism keeps strengthening because analysts are constantly raising earnings expectations due to highly resilient AI-related orders. You should pay attention to forward-looking estimates suggesting Applied Materials could approach a massive $44.2 billion in annual revenue by 2029. But you must remember that hitting this $44.2 billion target depends heavily on continued AI infrastructure investment and favorable capital expenditure cycles. You cannot afford to ignore the fact that these projections require your disciplined examination because revenue assumptions can weaken overnight if hyperscale investment slows down. Another major factor fueling this market performance is the rapid industry transition toward highly advanced chip architectures. You will have to navigate gate-all-around transistors, backside power delivery, chiplets, and advanced packaging to keep your competitive edge. Because these technology transitions drastically increase manufacturing complexity, they require many more processing steps per single wafer. You will find that a broad technology portfolio positions a company to benefit from multiple process nodes rather than relying on a single volatile manufacturing line. Despite these incredibly favorable dynamics, you must recognize that semiconductor equipment remains one of the most highly cyclical industries in the world. You are facing constantly evolving export restrictions affecting advanced semiconductor technologies across multiple international jurisdictions. If you suffer from heavy customer concentration among a limited number of leading foundries, your earnings are highly sensitive to sudden capital expenditure delays. L-Impact Solutions strongly advises you that sustainable shareholder value depends entirely on supply chain resilience, policy stability, and disciplined capital management. L-Impact Solutions reminds you that financial markets are currently pricing in AI infrastructure optimism much faster than they are pricing in real execution risk. When you see a stock price hit $602.50 after a 124% year-to-date gain, you must ensure that valuation expansion is backed by sustainable earnings quality. You must never rely on market sentiment alone to justify your long-term technology investments or corporate growth strategies. You need to keep a close eye on customer concentration because the global leading-edge semiconductor ecosystem is dominated by a shockingly small number of advanced manufacturers. The top hyperscale cloud providers are collectively planning well above $400 billion in annual AI-related infrastructure investments over the next several years. If even one major foundry or hyperscale customer postpones capacity expansion by just 10% to 20%, you could see billions of dollars in deferred orders. A minor 10% to 20% delay by a key customer instantly triggers lower factory utilization, weaker operating leverage, and deeply reduced earnings visibility for suppliers. You are operating in an environment where governments have steadily expanded restrictions covering advanced semiconductor manufacturing equipment and high-bandwidth memory production. You will see every additional licensing requirement increase your compliance costs, extend your sales cycles, and severely complicate your revenue recognition. Even with global semiconductor demand moving toward $800 billion annually, these regulatory hurdles can shrink your addressable market in the blink of an eye. You should expect extreme earnings volatility because history shows wafer fabrication equipment spending frequently fluctuates by 20% to 40% between expansion and correction cycles. After you watch a stock appreciate by more than 100% within a single year, the market's margin for error becomes incredibly thin. You might be surprised to learn that a quarterly revenue miss of only 3% to 5% or a gross margin compression of 100 basis points can trigger massive market corrections. If you reduce your customer guidance by even a modest amount, the resulting stock price drop can be materially larger than you ever anticipated. Impact Solutions openly questions whether you are growing too dependent on artificial intelligence as your primary investment narrative. While you know AI servers consume several times more semiconductor content than conventional systems, you cannot forget the value of traditional sectors. You need to remember that automotive semiconductors, industrial automation, communications, and consumer electronics still represent hundreds of billions of dollars in long-term demand. If you allocate excessive resources toward this single AI technology cycle instead of maintaining diversified end-market exposure, you will experience brutal earnings volatility. You should look beyond basic quarterly EPS revisions and start rigorously evaluating your free cash flow conversion and return on invested capital. To win over the next decade, you must focus heavily on research efficiency, supply chain resilience, and your total geopolitical risk exposure. Impact Solutions emphasizes that the companies generating the most sustainable shareholder returns will be those demonstrating disciplined capital allocation. You can build strategic resilience right now by aggressively expanding your revenue exposure across multiple completely different semiconductor segments. You should target vehicle electrification, advanced driver assistance systems, and software-defined vehicles to capitalize on long-term automotive manufacturing demand. You will achieve much stronger earnings stability throughout semiconductor cycles if you maintain a customer portfolio where no single client contributes more than 10% to 15% of your annual revenue. You must turn geographic diversification into a board-level strategic priority because governments are investing hundreds of billions of dollars into domestic chip capacity. If you establish multi-region manufacturing capabilities and supplier redundancy, you will successfully lower your geopolitical concentration risk and shorten customer lead times. You need to enforce strict capital allocation discipline by requiring measurable investment thresholds, such as keeping minimum factory utilization rates above 80%. You should ensure your targeted return on invested capital always exceeds your weighted average cost of capital before expanding any manufacturing capacity. You must prioritize your research and development spending on advanced packaging, chiplet integration, backside power delivery, and sustainable manufacturing practices. Because advanced packaging demand is growing at a projected double-digit annual rate, a balanced R&D portfolio lets you capture a much broader share of WFE spending. You can easily translate a minor 2% to 3% improvement in manufacturing yield or operating efficiency into hundreds of millions of dollars in long-term value. You should continuously monitor customer concentration ratios, export compliance status, and supplier financial health using automated, data-driven executive dashboards. You must build comprehensive scenario models that stress-test your balance sheet against sudden 20% to 30% reductions in semiconductor capital expenditure. Ultimately, you should focus your energy on building a resilient operating model that generates durable earnings and free cash flow regardless of changing macroeconomic conditions. Is your AI growth strategy hostage to the CapEx whims of just 3 clients? Comment below. For more strategic analyses, visit our business consultancy website, link in the description below. Thank you.